Today, we're going to crack the code. We are diving deep into the engine room of the global economy to uncover the hidden connections between bonds, stocks, and interest rates. You know, the invisible forces that are pretty much always pulling the strings. Have you ever wondered about that? Why some announcement about a fraction of a percent can send the markets into a total frenzy? It sounds incredibly complex, but I promise, by the end of this, you'll see it's all based on a few core ideas that actually make a ton of sense. So let's get into it. Okay, first things first, we have to start with the bedrock of the bond market, because everything else we're going to talk about today is built on one simple but super powerful inverse relationship. And this image is the perfect way to picture it. Seriously, just lock this seesaw into your brain. On one side, you have interest rates. On the other, the price of a bond that's already out there. And the rule is simple. When one side goes up, the other has to come down. It's a law of financial gravity. Now, before we go any further, let's nail down a key term: yield. A bond pays you a fixed amount of cash every year. That's called the coupon. But the yield, that's your real return. It's what that fixed cash payment looks like as a percentage of whatever you actually paid for the bond on the open market. Let's put some numbers on this to make it crystal clear. Okay, look at situation A. You buy a bond for $5,000. It pays you a fixed 200-pound coupon. Simple math, that's a 4% yield. But now, check out situation B. The bond becomes more popular and its price gets pushed up to $5,500. You're still only getting that same 200-pound coupon, so your actual yield, your return, drops to 3.64%. See? The price went up, the yield went down. The seesaw is in action. And of course, the exact opposite happens in situation C. The price falls and your yield goes up. So, we've got it. Bond prices and yields are on that seesaw, moving in opposite directions. But what's pushing on the seesaw? What's this big external force that gets the whole thing moving? Well, that brings us to the big one: market interest rates, the kind that central banks are always talking about. And here is the absolute golden rule. When a central bank raises interest rates, any new bonds being issued from that day forward are going to offer a higher, more attractive payment. And what does that do? It instantly makes all the old bonds with their lower fixed payments look a lot less appealing. Let's just walk through the logic here. Imagine you own a bond and it pays you 3%. Then, bam, the central bank raises rates. Suddenly, brand new bonds are hitting the market paying 4%. Now, if you want to sell your old 3% bond, think about it. Why would anyone pay you full price for it when they can just go buy a new one that pays more? They wouldn't. The only way you can compete, the only way to make your old bond attractive, is to sell it at a discount. You have to lower the price. And that right there, that's the mechanism that links central bank decisions to the price of every single bond out there. Okay, perfect. So we've built the connection from interest rates to the bond market. Now we're ready for the next piece of the puzzle: how this all spills over from the safe world of bonds into the much wilder world of stocks. This quote from IG International just hits the nail on the head. You have to think of all the investment money in the world as one giant but limited pool of capital. And stocks and bonds are in a constant tug of war, fighting for every dollar in that pool. And this breaks down the classic trade-off every investor has to make. Stocks, on one hand, give you a piece of the action, ownership in a company, with higher potential for growth, but of course higher risk. Bonds, on the other hand, are basically just you acting as a lender. They're much safer, much more stable, but usually that means a lower return. Every single investor is constantly weighing this balance. And that whole calculation can change in a heartbeat depending on the economic weather. When things look stormy and the stock market seems shaky, investors do something called a flight to safety. It's exactly what it sounds like. They start selling their riskier stocks and pour all that cash into the relative safety of government bonds. That flood of money drives bond prices up and, as we know, their yields down. So we've built the chain, right? From interest rates to bonds and from bonds to stocks. But what if I told you that's not even the whole story? We need to zoom out now, because these aren't just isolated chains, they're all part of one giant interconnected web. See, when you look at the big picture, what's called intermarket analysis, you're really tracking four major players. We've talked about stocks and bonds, but you absolutely have to factor in commodities. We're talking about the raw materials of the economy, like oil and copper. And of course, currencies, like the US dollar, which kind of act like the scorecard for how a country's economy is doing. And check this out, because this chart is fascinating.
it shows another one of these powerful seesaw relationships in action. On top, in green, you've got the US dollar. And below it, in gold, is a major commodity index. I mean, look at that. They are almost perfect mirror images of each other.
The rule here is actually pretty straightforward, because most of the world's big commodities, think oil, copper, corn, are all priced in US dollars. When the dollar gets weaker, it simply takes more of those weaker dollars to buy the same barrel of oil. So as the dollar falls, commodity prices almost always have to rise. It's just another financial seesaw. Okay, so we've built this really nice, clean model of how things are supposed to work. But now it's time for a crucial dose of reality. Because these powerful relationships, well, they can bend, and sometimes they can even break. This quote from the investment firm Schroders is like a healthy splash of cold water. While all the principles we've talked about are the foundation, the way they play out in the real world isn't always so clean. History shows us these connections can shift and change. So what's the bottom line here? It's that context is everything. Think about it. Are interest rates rising slowly because the economy's booming? Or are they being hiked really fast to fight scary inflation in a weak economy? Those two scenarios can cause investors to react in totally different ways, bending these historical relationships. And that really leaves us with the big takeaway. The financial world is not a bunch of separate boxes. It's one huge interconnected web. A small tremor in the currency markets can signal a big move in commodities, which can impact inflation, which forces the hand of central banks on interest rates, which in turn shakes up both the bond and stock markets. So the real question isn't just what are stocks doing today? It's where, in this entire web, is the next big signal about